I'm Bruce Kirsch, and thank you for joining us today. This webinar is How Real Estate Developers Price the Dirt, Residual Land Valuation, and Comparable Sales. Just a note on real estate financial modeling, we offer all of the services and products that you see here as well as on our website. Things are growing right now in our company and the real estate market is improving. Please let us know if we can help you in any way. Okay, so let's get started. I want to start by talking about the extent to which a real estate developer has control over the various elements in a development transaction. Okay, and so let's take a look first at hard costs. Because those are comprised of global commodities prices and local labor market costs, the developer really has very little control over that element, which is 50 to 60% of the typical development budget. With soft costs, the developer is going to be paying market rates for architectural, engineering, consultants, legal, and so on, so they have little control there. The cost of construction debt, bank debt, little control there as well. The investor returns requirements, little control there because investors are seeking a certain level of return for a development transaction. However, with respect to land cost, there is potentially more than a little control that they can exercise over that line item in the development budget. So let's take a look at that in some more detail. And so the question becomes, well, how is land different from all of these other categories of development costs? Well, no piece of land, no site is receiving on a rolling basis a constant high volume of purchase offers every month of every year. Every piece of land is unique with respect to its location, its physicality, and sites almost always have zoning restrictions imposed upon them that limit the allowable uses that can exist on the site. In addition, the real estate market operates within a cycle. So some pieces of land which are zoned for a particular use are going to be in demand during certain parts of, let's say, a 10-year cycle, and they'll be hot during certain parts of that cycle, and then they'll be less hot during other parts of the cycle, and so on. So land, in essence, is really the ultimate illiquid asset. And land sellers should feel very lucky when they get an offer on their land that would actually go to closing at the price that was offered. Okay, so land is slightly different from all of these other items. Every site is entirely unique as opposed to a brick is a brick is a brick with respect to construction hard costs, and it's extremely illiquid. And so what developers do, because they realize the illiquid nature of land, is they realize that they have some negotiation ability around the land purchase price. And the way that they come to understand the purchase price that they are willing to offer is through the residual land valuation method, and also, as we will discuss later, through comparable sales data points. So developers use residual land valuation as one method of deciding what to pay for a development site. And so let's take a look at the elements here that will allow us to back solve for this residual or remaining land value. The top element is estimated income. Then we will subtract out the estimated cost of the project exclusive of the land. Then we will subtract out the required equity return, and what's left over, the residue, is the land value that the developer is willing to pay as a purchase price, the maximum purchase price that they would be willing to pay. Okay, so let's take a look at this in a little bit more detail and say, well, what is the developer really thinking in their head with respect to each of these elements? So for the first element, income, the developer's internal monologue is saying, well, what can I build on the site and what can I generate in income? So it's either rents or sales if it's housing development or a condominium building. When we take a look at backing out the cost, the question that they're asking is, well, what will it cost me in total to build, operate, and lease up or sell out this building? And with respect to the required return, they are asking the question, what pre-tax margin do I and my investors need to make for this to be worth putting our capital at risk and devoting our time? And so when we talk about pre-tax margin, as we see in the asterisk, for income-producing properties, this is going to be measured using the yield on cost, which is the NOI, or net operating income, divided by the total development project cost. And for unit sales projects, again, housing subdivisions or condominium buildings, this is measured as profit margin, which is calculated by taking net cash flow and dividing by the gross sales proceeds. Okay, and so if we take the estimated income, back out the estimated cost, exclusive of the land, back out the required return in terms of dollars, this is going to leave us with the residual amount, okay, that we can reason the land is worth for this contemplated development project. And so the residual land valuation process is as follows. Before we get knee-deep in spreadsheets and start spending hours on end trying to make sure that everything is adding correctly and so on, we're typically going to take a first pass using a back-of-the-envelope analysis. This is also known as a static analysis, meaning that we're not really taking the passage of time into account. And so what we'll do with one of these real simple one-pager back-of-the-envelope models, which we will use in a moment, is we're going to make inputs for all of the variables, including the land cost, okay? And then we're going to iteratively make changes to the land cost input and the other variables until the desired profit margin or target return thresholds are met. In other words, we'll make changes to these items until the economics of the project look attractive. And so when all is said and done, if the land cost or the intended purchase price that you back solve to is not something that you think the seller would seriously entertain, then you need to move on to evaluating the next site. If it is something that you think the land seller would entertain, okay, say that they're asking $25 million for the land, and you calculate that you can pay up to 23.5, so you're in the same universe, okay, then we would take the time and effort and proceed to run a multi-year projection model, which is also known as a pro forma, that is going to allocate all of these project costs and the assets generated income over time, okay, projecting forward over multiple time periods. And then we'll use the net present value and the internal rate of return measurements to fine-tune the amount that we are in fact willing to offer as the land purchase price. Okay, so these are the basic steps. We'll start with the back-of-the-envelope analysis. We'll iterate it by changing the variables, including the land cost, the hard costs, and so on. And if it's promising, we'll go ahead and run a DCF, or discounted cash flow analysis. Okay, and the discounted cash flow analysis is significantly more complicated and requires significantly more inputs than a back-of-the-envelope and takes more time. And so this is an example of one of our input screens for our condominium model, and here's another input screen. So there are far more inputs that you need to go through, and here's the timeline as an example over which we would be measuring things such as the IRR and net present value. Okay, so that is a multi-period analysis. Again, though, before we get involved in all of that, before we make the investment of time and energy, we're going to simply do a back-of-the-envelope analysis first. And so if we take a look at the equation here on the left, which we've looked at twice already, and we say, well, what if we wanted to invert these two pieces, the one for required return and the residual land value? Could we do that? Mathematically, could we do that? So this is just a simple algebra equation. And so the answer is yes. I could simply add the equity return to both sides of the equation and subtract the residual land value to both sides of the equation, and this is the resulting equation. So in other words, I have estimated income minus estimated cost minus residual land value, which is an estimate for the land purchase price, and that will give us our required equity return or pre-tax margin. And so what we're looking at here on the right, this is exactly how our back-of-the-envelope models work. And so I wanted to just give you this overview before we stepped into them such that you understood what the bottom line was, so to speak, and then how we work through that. And so this is what we're now going to take a look at in the Excel. And so we have in the slides here some examples, but let's just go ahead now and let's hop into the Excel and do some hands-on work. And so I'm going to zoom in here. I'm in the residual land valuation version 4.0, and I'm going to click to the first tab, which is office industrial development. And now I'm going to zoom in so that this is nice and readable for everybody. Okay, and so what we have here is a tab where we simply, in a one-page format, are going to enter in all of the key variables that answer those three main questions in the developer's internal monologue. Well, the first thing before we get to understanding what can I get or generate in income is we also need to know first, what can I build on the site? What is required if I were to build that with respect to parking or, let's say, affordable housing? And so as we say here, everything that you see in blue is a user input, and these are the values that are intended to be changed by the operator of the Excel sheet. And so let's say we had a 25,000 square foot lot, which is roughly half an acre, and on that lot the government says we can build up to 8 times that lot area, or a building with a gross square footage above grade of 200,000 FAR. And then if we were to assume it's a mixed-use prototype, let's back out some portion of that for retail, which is going to leave us with a residual gross square footage for the office use of 188,000. Against that, we now need to apply an efficiency factor, which is going to slim down, reduce the number of square feet that we can actually rent. And this is one of the things that makes development hard and inherently challenging, is that, well, we have to pay to build the whole building, but we can only monetize a portion of that total physical space. And so what we're left with here is the following. We have a 200,000 square foot building, 171,000 rentable square feet for the office use, and let's say that the requirement is that we have 1.2 parking spots for every 1,000 rentable square feet, which means we need to build 205 parking spots. Okay, so with 3 or 4 inputs, we immediately have some visual conceptualization of the physical manifestation of this asset. So that's good for us in terms of thinking visually as a developer. It's really important to understand how these things might work out in actuality. Okay, so let's move down to the next part. Well, what could I generate in net operating income? So here we would put in an assumption of today's rents. This is a full service rent estimate on an annual per square foot basis. So for each square foot of office space, we could charge annually $65 a foot on average. We're not saying, well, this tenant's going to pay $65 and the next one's going to pay $58 and so on and so forth. We don't need to get down to that level of detail. Right now we're just doing a quick pass on this to see if the economics are supportable. So let's say it's $65, and then for the parking, let's say we can get $200 per parking spot per month. And so we can do some simple math to say, well, what's the gross potential operating income on the office? And we say, well, that's the 170,000 times 65 a foot. And what about the parking? That's the number of spots times the number for the monthly times 12. And then we can back out some vacancy on both of those, which will give us a total annual revenue net. And so essentially what we're doing here is we're saying, if I could snap my fingers and the building that I'm envisioning would appear on the lot, and I were to have it leased up at today's rents, this is the revenue that that building would generate today, right now. And we do the same thing for the operating expenses, because we need to get to an NOI, or net operating income number. And so we have some estimates there and apply those against the rentable and total those up. For the retail, we say, well, we have 12,000 square feet. On average, we're going to get $35 on a triple net basis, so this would be our net operating income. And so when we sum the 11 million minus 5 and then the 420, this is what we can call the current stabilized net operating income. So as I said, again, if we could snap our fingers and this building would appear and it would be tenanted with the type of tenants that we are envisioning, it would generate today roughly $6 million a year. And so let's put a pin in that and let's keep that in mind. The next piece is, well, what would it cost to develop? And now we also want to think on a rough basis, well, how long would it take to build and how long would it take to stabilize? So we can make inputs here for pre-construction duration, how long it would take to construct, and then how long we think it will take to lease up. And we add those three together, and this just gives us an idea, roughly speaking. Okay, this is going to take us roughly 5 years from start to finish. That's a long time. And we can also use that passage of time to escalate our rents and our costs if we would like, which we'll show you in a second. Now let's go to the hard costs. Let's say we know a rule of thumb for this type of building in our geography is $225 a square foot for the hard cost for an office building. So we multiply that by the 200,000 above grade. And then for tenant improvements, we can't forget those. We're going to multiply that assumption by our rentable square footage up here. And we do the same for retail. And then we can make some assumptions as to what percentage of the total hard costs the soft costs would be. And then we're going to start to think about financing. Okay, so we know that we're going to take a loan to capitalize the project. So that is going to generate naturally some interest and likely some financing deficit with respect to the asset. So we need to carry that in our total project cost estimate as well. And so what we do here is the following. We say, all right, I'm assuming I get a 65% loan to cost for the construction of the asset. Let's say it's at 6% and it's going to capitalize the interest. And so we can run this formula here, which is going to take the total number of months and then divide by 2 to figure out on average, roughly speaking, what would my total interest be for a total loan period of 63 months. And so we have a note here which says on average, 1/2 of the total loan amount is outstanding over this entire 63-month timeline. And this is, again, roughing it, but we need to have something in there. And so next, we have an input for the land cost. And what we're going to do here, as we said, is we're going to include the land cost such that we can generate a return metric, and then from there we can modify the land cost to approach the targeted return amount. So let's just say that we're going to start out with a $13.5 million land cost. And so when we sum all of these project costs up, this is a $100 million building to build and buy the land, which is roughly $500 a foot. And so if we take that NOI that we had assumed of $6 million and divide it by $100 million, it's a roughly 6% current cap rate. NOI, yield on cost. That's the NOI divided by that total project cost. All those numbers seem to make sense to us. Now, let's keep that in mind. Moving down, how would I fund this? You need to think about these things too. I'm going to put in some equity. I'm going to put in some senior debt, which I had already determined was going to be a 65% loan to cost. This is going to drive down here. 65% times the $100 million. And then if we don't have enough equity, we're not able to raise more than $15 million, let's say, then there would be a mezzanine loan piece. So let's assume we have all of that. And so now that we have an idea of how much it's going to cost to build the asset and how we're going to fund all of those costs, now we can take a look a little bit into the future here and say, well, what would that future stabilized NOI or profit margin be on this asset? And so we can now grow that NOI amount, which we said was $6 million today, and we can grow that by growth rates for income and then back out those grown or compounded amounts for operating expenses and taxes to this point in the future 6 years hence. And so what we're saying here is at the point of stabilization, after 63 months have elapsed, our NOI on this asset is not going to be $6 million, but hopefully everything will have grown in that way. it'll be more like $7.3 million, which will tell us that this future return is more like 7.5%. And so without even thinking about the eventual sale of the building, what we can do now is say, all right, well, if I need to hit an 8% and everything else will remain the same, let me solve for that 8% by altering my land purchase price. Again, assuming everything else remains the same. And so the way that we're going to do this is we're going to use the goal seek function. And so I want everybody to do this. Go to your data tab and to the what if analysis button and then select goal seek. Alternatively, you can do Alt T as in Tom, G as in goal seek, and it's going to bring up this box. And so in this dialog box, what we want to put in the first cell is, well, I want to solve for a future cap rate of 8%, let's say. So I'm going to set cell F as in Frank 65 to value 0.08 by changing cell F as in Frank 46, which is my land cost. Okay, now Excel's going to do this work for us. And I'm simply going to click it. It's going to solve for it. It says target value 0.08, current value 8.01. I click OK, and we see that our land purchase price came down significantly. From a 13.5, it got essentially chopped in half. And so that purchase price for the land allows us to get to this 8% cap rate. And so this is the point where we ask ourselves, all right, well, if they're asking, let's say they're asking 15 and we started out at 13.5, and we're going to go in at 7 because those the only way that the economics will work for us, let's just move on. They're asking way too high. They don't understand the real economics. They don't understand the real worth of the land. And so this is all through the lens of a residual land valuation methodology. And so we can also take it a step further where we say, all right, well, what if we want to assume a sale in the future? What would that cap rate be? What would the building sell for? And what would the margin be just on the sale alone? But really, for an income-producing asset, typically what we're going to do is target some sort of current NOI by changing the land price or some future stabilized NOI that assumes certain growth rates and a certain elapsing of time. So now what I'm going to do is I'm going to zoom out, all right? And I know that this is a lot and it's in a very short period of time, but what I'm going to do now is I'm going to just press this one button up in the very top corner here. It's a number 1. And that's going to collapse all of my grouped areas on the spreadsheet. And so now what I see is essentially just these 3 major questions that we started out with. What could I generate in net operating income? This is the result that we had. What would it cost to develop? Here's my land cost, okay? What would I get in income? Here's my income. And now, on a more simplified basis, instead of having all the other noise, I can say, well, you know what? I'm never going to get $7 million for a price. Maybe I can get $9 million. He would agree to $9 million. And so if I put $9 million in, well, where does that leave me with my future stabilized yield on cost? And so now I can, again, use the goal seek as we did, which automates it, or I can simply iteratively fiddle around with this number and see how these results change in real time. And so this is the benefit of running a quick back-of-the-envelope analysis, is you get to a litmus test, essentially, as to whether the land asking price is reasonable given all of these other assumptions. And now this should probably impress upon you how important every other assumption is. Well, what if you could get $80 a foot in rent? So you can change F17 to $80, and we're targeting an 8%. Well, now my future stabilized NOI is 11. Well, now suddenly I can pay a whole heck of a lot more for the land. So this is exactly the process that we go through over and over again to see if what they're asking is within reason or if we should just move on. All right, and so this is an example for an income-producing property. We can click next to the condo development model tab, which has the same exact setup, but this is for a unit sales asset. And so we ask these same exact questions, but instead of estimating income based off of rents and operating expenses, we estimate income based off of sale prices for individual housing units. And this is actually a pretty sophisticated one. And all of these are available for free on our website, incidentally, in the free tools section. And so now we can take a look, well, what kind of income are we going to generate through this condo deal? Well, we have 10% pre-sold, and the discount on pre-sold units is going to be 10%. And our regular market price for an average unit is $500,000, and our price for an affordable unit is $175,000. And that's going to give us gross proceeds of $70.4 million. We're going to sell parking, we're going to sell storage, and so on. After selling costs, this is our net proceeds for the residential component. We can do the same for the retail component, except here we're going to apply a cap rate just to the retail, whereas before we applied a single cap rate to both the office cash flow stream and to the retail on a commingled basis. And so when we add these two together, the residential net proceeds and the retail net proceeds, this is the answer to what amount of income could I generate. And then again, we go through this same exact exercise with respect to timing and hard costs and soft costs, and starting out with a placeholder for the land costs. Again, targeting a certain profit margin. And in this case, the profit margin is our pre-tax profit divided by our gross sales, which is up here. And again, we can now iterate on all of these variables over and over to solve for a certain level of return. Let's say we need a 30%, or let's say we need a 2.0 multiple. Okay, well, what if I change this to 11.5? How does that work for us? And again, this is what we are going to do before we get involved in a full-blown discounted cash flow analysis, which is essentially a more precise version of this residual analysis, except instead of just looking at all of these numbers today in time, at this very point in time, we're going to look at them over time and then discount cash flows back by the appropriate number of periods. Before we go back to the slides, I just want to point out we also have a back of the envelope here for condos, but on an FAR basis as opposed to a units basis. Depends on the zoning as to how you would need to analyze that. So that is also there just as an FYI. And now let's go back to the PowerPoint and just step through what we've gone through already. And now let's talk about, lastly, the comparable sales method. And so everything that we've done so far is related to residual land value. And with respect to comparable sales, this is essentially just looking at market data and saying, well, last month there was a piece of land for a condominium building to be built that was sold for $350,000 per condominium unit, or $90 a foot, however you want to think about it. And so you want to gather all of these relevant pieces of data that are as similar as possible. And when we say similar, we mean the same uses are allowed on the site, the same sub-market, not Detroit versus downtown Manhattan, and also a similar set of sophisticated buyers and sellers, because sometimes people get the wool pulled over their eyes. And so the question becomes, well, where do you get these land comps? Well, you get them from brokers. This is what the investment sales brokers do, is they track all of this data. So you need to befriend a broker and understand what those data points are. Now the question becomes, well, can you trust the information? Well, sometimes yes, sometimes no. You need to always exercise your business judgment as to whether you believe these numbers that are out there in the marketplace. Naturally, it's always good to look at tax records if tax records are available. But sometimes it's hard to derive the land value if there were, say, an existing building on the land and they were going to use that to generate some income while they get permits and so on. And so what we do is we now bring together the residual valuation conclusion and the comparable sales data points, and we use them in concert with one another. Neither is right or wrong. We now need to compare them and use them as a sanity check against one another. If my residual land valuation calculations told me that I could afford to pay $100 a foot for land, but all of the recent transactions on very similar sites were at $70 to $80 a foot for land, this should cause your antennae to go up. You're really high. And so maybe that's justified, but maybe it's not. And so this is what you're going to do now, is push these values and calculations against one another to really come to understand what you think the land is worth.